Brad Williams, Frugal Finance. Here's a quick video on public companies. What's a public company? Think of Apple. Think of NVIDIA. Think of Walmart. Think of General Motors. Those are all considered public companies. But from investor.gov, the Securities Exchange Commission, this is what they define as a public company. Public companies are a key part of the American economy. They play a major role in the savings, investments, and retirement plans of many Americans. That should say most Americans, but because a lot of people don't understand investing, I'd like to say many and exchange that with most. It would be nice if most Americans were able to put more money into public companies, into stocks. If you have a pension plan or own a mutual fund or ETF, chances are that the plan or mutual fund owns stocks in public companies. Like millions of Americans, you may also invest directly in public companies. What is a public company? The term public company can be defined in various ways. There are two commonly understood ways in which the company is considered public. First, the company's security trades on a public market. And second, the company discloses certain business and financial information regularly to the public. Now, there's a bunch of documentation required by the Securities Exchange Commission mandated back in 1929, 1830. We had that huge depression, and subsequently there were laws put in place. The Securities Exchange Act, 1932. I think it was earmarked in 31, but the dates aren't that important. In other words, if you're a public company, you have a lot of scrutiny that you must follow. And if not, you're going to get sued. In general, we use the term to refer to a public company as public reporting obligations. Companies are subject to public reporting requirements if they sell securities in a public offering, such as an initial public offering or IPO. I have videos on these. Allow their investors base to reach a certain size, which triggers public reporting obligations, or voluntarily register with us. A private company also can become subject to public reporting requirements by merging with a public shell company. We see this all the time. SPACs. We saw this scammy kind of product. It's been around a long time. Some guy brought this along in the late 80s, but it was never introduced to any fanfare. And then somebody dusted it off, remarketed it, and it's all about timing. Then we had these SPACs that were highly promoted by celebrities who subsequently were taking huge chunks of these never-ending scams. And subsequently, well, the SPAC market lasted for about a minute and a half and then blew up because it just wasn't sensible. And that's why it wasn't sensible back in the 80s. Well, sometimes you got to kick a can and find that eventually it just never goes anywhere. This process, if you merge a public company to a shell company, the process is called a reverse merger. As with any investment, investors should proceed with caution when considering whether to invest in reverse merger companies. A lot of stuff in 2023, a lot of junk, and into 2024. And I have a lot of names that I could throw out, but I won't. Just because they're always doing this and they're always trying to screw the consumer. And subsequently, there are a lot of suckers that follow into the hype. And as mentioned, we view companies as public if they're subject to public reporting obligations. There are instances, however, where the securities of a company that does not regularly report business and financial information to the public are nonetheless traded on small public markets. Yeah, this thing is called the pink sheets. Stay away. Just stay away. They were formerly publicly traded companies. They never made money, so they were delisted. Then they go to a shallow grave where they eventually die, but they'll take suckers along with them. Investing in these companies can be risky since they report very little information. And then what information they do promote, you're going to read it on Reddit or one of these social media platforms where it's called pump and dump. Well, live and learn, all right? If you're going to play that route, you're going to get burned unless you're one of these scammy promoters that are trying to pump up a stock and then dump it while leaving you hanging, losing a lot of money. Transparency and continuing disclosures. A public company's disclosure obligations begin with the initial registration statement that is with the SEC. It's called a red herring. This is the stuff, if you're going pre-IPO, they'll issue a preliminary prospectus, and technically it's called a red herring. And it doesn't have the numbers, but it gives you an idea of what the company's supposed to do. And then generally 24 to 48 hours before they do go public, they'll throw out some numbers. But again, on an IPO, it's really hard to come up with accuracy. So again, it's buyer beware. A public company's disclosure obligations begin with the initial registration statement, as I stated, but the disclosure requirements don't end there. Public companies must continue to keep their shareholders informed on a regular basis by filing periodic reports and other material with the SEC. The SEC makes these documents publicly available without charge on its Edgar website. I don't like the Edgar website. It's cumbersome. It's just clunky. What I recommend is just go to investor relations of any particular company that you're interested in that is either already public or about to go public. They're going to have this information. It's much easier to navigate and read. Just, again, type in Walmart investor relations. Then you're going to be able to weed through all of their quarterly and annual and other SEC requirements. They're also going to have other reporting information. In other words, they're going to have a lot of puff presented by their marketing people. Go to the SEC information. Again, I have videos on all of this stuff, but if you want to read the puff, read all of the, how great they are, then read their internal stuff. Otherwise, go to the boring SEC site and take a look at this information. Following are some of the reports that may be filed by U.S. public companies. You have their annual report on Form 10-K. I have videos on all this. Just go to Frugal Finance on YouTube, look at the playlist, and there'll be information. Just do a search and you're going to find all that information. Quarterly reports, and I have a video on how to read all this stuff. Then you're going to have your Form 8K. Companies file these reports to SEC to announce major events shareholders should know about, including bankruptcy proceedings, a change in corporate leadership, such as a new director, or high-level officer, and preliminary earnings announcements. Proxy statements, shareholders voting constitutes one of the key rights of shareholders. The game is so one-sided. You can have multiple classes of shares. You can have a Class A, a Class B, some even go Class C and Class D, and that would be a Google or a Meta. In other words, for Meta, Zuckerberg wants to control that company forever, so he has majority rights. It doesn't matter what you think, or if you want to try to make changes to Meta, good luck, because Zuckerberg has control of the company, and it doesn't matter what you do with their Class A, he controls Class B, which has a majority voting right. Again, if you're going to play this game, you better know the ins and outs. Additional disclosures, there's just endless documentation, which is great. And there are people on Wall Street, portfolio analysts, who read this stuff inside and out. That's their job. They work 14 hours a day, and they have to know all of this stuff. Comment. Let me know. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.